In almost every category, we've had good growth. And rather than talking about actual division, it's probably better to talk category. Our clothing category across the group was up just over 18%, at 18.3. Jewelry, as you said, was probably the softest growth at 7.9. But I think it's fair to say that that is all relative. That as a figure for a discretionary product like jewelry, relative to other markets across the market, is actually not a bad figure, and we're quite satisfied with that growth. Our cell phone growth was 23.9%, our cosmetics was 10.3%, and the homeware and furniture was up 18%, which in total gave us 17% growth. And from our perspective, in all these product categories, we've gained quite significant market share during the course of this past year and the previous year, in fact.
It's interesting that you say that gross margins have stayed flat for the period, and that was a conscious decision, choosing to pass on efficiency gains to consumers. You're looking at product inflation averaging 6% during the period, so that's pretty much in line with where we've seen inflation for some time now. But just walk us through the rationale behind that decision.
It's absolutely consistent with what we did for our last financial year as well, where we held the margins. We've been doing a lot of work on our supply chain and improving our supply base and getting sourcing efficiencies. And our strategy has been really to pass any efficiencies and benefits through to the consumer with a view to driving top-line growth and gaining market share. We think that strategy has been working, and we believe that the results over the last 2 years are evidence of that.
How comfortable are you with the level of growth you've seen in new credit accounts over the period? Because increasing interest income there by 15% to around 1.71 billion rand, and you have indicated that you've hit a record number of new clients on that end. So how comfortable are you with, I suppose, bad debts and the level of impairments that you've had to endure over the period?
Well, we haven't changed our credit criteria, and we're quite conservative with our credit granting. I think it's more to do with the two things. I think it's our approach to acquiring customers, which we've been working on over the last 2 or 3 years. And I think also if you've got the right product in the stores, that also encourages customers to open accounts. We have seen a slight rise in our bad debt. That is not unexpected when you've got a much higher proportion of new accounts on your database. New accounts tend to have a bad debt performance which isn't as great as long-term accounts, and as it's a higher proportion of our account database, we expect a slight deterioration in our bad debts, but that's very much in line with our expectations, and we're comfortable with that.
Interesting that you're choosing to step away from the usual target markets and entering the high-end target markets through the acquisition of Fabiani, and through that you've also purchased two G stores under during the period. So what are the plans for Fabiani going forward now? Where are you intending to grow that brand?
Well, it's into an area or a market that we haven't traded in previously, so we think that that's important and that there's no cannibalization there. And both Fabiani and G-Star, we think have, particularly Fabiani, have very good rollout potential over the next few years, and we would intend to roll stores out in the coming years, and we think that there's substantial potential in that brand.
Tell us about the new stores and the number of stores that you are planning to roll out, because you currently have 1,857 stores. You increased your floor space by around 7.7% during the period. And of that, you've got 87 stores in Africa. So where are you concentrating your focus right now, and what type of stores are you going to be opening over the next while?
Well, the number of stores will be really across the board in almost all the trading companies. We already know that in this coming financial year there will be probably in excess of 140 new stores, and our space growth will probably be 6% or more in this coming year. Africa is obviously an area that we are looking at moving into. We already have in excess of, I think it's around 87 stores there. We're looking over the next 2 to 3 years to increase that to closer to 150 stores and looking at doubling that turnover. Obviously, Africa is more a medium-term target. There's significant store openings happening in South Africa. In fact, I think in the plans of the 140 stores that I mentioned, about 16 of them are outside of our borders into Africa.